Welcome to the KP Podcast, where we talk about the business of real estate. A podcast about leveraging opportunities, growing your business, and experiencing financial freedom. Here are your hosts, Keith Anderson and Peter Cambukos.
Hey everybody, welcome back to the KP Podcast. We're coming to you from the Forum. I am Pete, sitting here with your co-host Keith. And Keith, what everyone out there doesn't know is that this was take number 7 because somebody kept making me laugh going into the show.
But I appreciate the compliment. I am a funny dude.
You're funny looking, very, very much so. How's everything going?
Things are going good, man. In fact, it's about a little bit about what we're talking today. We're going to dive into financing today, which is pretty cool. Financing, flips, buy and hold, some strategies and some things that a lot of investors and real estate agents on our team and out there in the industry are asking about because it's starting to pick up a little bit on certain flips and certain opportunities.
Yeah, and with the higher interest rates, they're trying to figure out, like, what are my other options? How can I get these properties? What can I do? So, yeah, we'll dive into that in a second.
Yeah, and so to bring this to light, one of the other reasons is I had a cool guest come to my office yesterday and talk to me about investments, flips, buy and hold, and strategies.
Who was that?
You didn't know who came over?
I wasn't there.
It was a Jets football player that came over to my office
did he
yesterday.
Come by?
Yeah, Chris Strevler was over
awesome.
at the office.
So you got to meet him, huh?
Yes.
And I was gone. Did you explain to him? Did you guys talk about how the Jets are getting the division this year?
Oh, okay.
And this is the year?
I don't know if we did go deep on a lot of this stuff. And first off, I'd like to start by saying Chris is an awesome dude. Awesome, cool guy. It saddens me to say that I became a little bit more of a Jets fan after our conversation.
Right. You guys all heard that. It's on tape now.
Like,
we got you.
It went up. Like, I was like 0%, and now I'm a 0.01%, and it's really just Chris there I'm rooting for.
So you're saying you are, in fact, a part of the Jets fan. That's what
I'm telling you there's a chance. Okay, there's a chance.
That's
so
awesome.
Good wishes to you out there, Chris. Good luck this season, man. I know you're going to be pushing for a roster spot and really competing. The news story that I've heard is that Aaron Rodgers really sucks. So I'm assuming you got a good line of sight to go in there and get that. But
God,
in all seriousness, great convo. And so it's cool because we're talking to more and more athletes and celebrities and people in our industry that have come to us and talked to us about, like, hey, how do I get into this real estate thing, right? Like, how do I get into these financing and flips? It's like I'm good in my industry, but what ends up happening is a lot of these people, they all go full circle and they come back to real estate because that's kind of where wealth just consistently lives and grows and builds.
Yep.
Not everybody wants to jump into the investment side, but buy and hold becomes a very serious way, not only for the tax benefits, like we've talked about many, many times, but just to leverage your capital in ways that honestly hardly any other industries can offer the same long-term power effects that real estate does.
Yeah, it's very different. I mean, I would consider the buy and hold, the investment side, not so much the flips.
Yeah.
But yeah, they're very, very different strategies. And we've gone over some of that stuff in other podcasts. What's the flips is more of a business. You're finding the deals, you're flipping the deals. You're running the show during that time, and then you got to go out and find another one, as opposed to the buy and hold, which is more of a long-term play, and certainly, what I prefer, and I think both of us probably, prefer that. I would say with flips, there's nothing wrong with either one of them. You're getting your capital. That buy and hold is more that long-term strategy. But today, specifically, we're not talking about finding those deals or how you run each one. We're gonna focus a little bit on the financing thing, like we said.
Yeah.
And the options that are out there. How do you go about getting the money to get that deal? Because, there's that old saying that goes, you need money to buy that real estate. It just doesn't have to be your money. But it's got to be somebody's money. Money has to be involved somewhere. Most of the time. Not all the time.
And it also determines whether or not you're going to be doing a job, right, versus actually doing the ownership or the investment portion of it, right? So, like, you could technically flip houses with no money at all and leverage someone else's money entirely, and you're supporting an investor and kind of doing the job of flipping the house and helping maybe sharing some of the equity. Right. We know a few agents and a few friends that's what they do. They find private investors that have 100% of the money. Yep. They still go get hard financing, but they leverage a private investor's capital for the seed money, the down payment, and the actual construction cost, but they manage the project, do the whole facilitation of it, and then do the flip and leverage it that way. So you have options. You don't have to take this thing down yourself. there are two plays into that.
And I think that's a perfect example depends on which side you're coming from, right?
Yeah.
Because you look at that example, you've got two people that are both involved in the deal. One, like you said, doesn't have a lot of the finances, but they're running the deal. They're doing the day-to-day. They're doing the work, right? But they're not coming with that much capital, if any. And then you've got someone on the other side, maybe they're a little more experienced, a little more well-off. Now they're putting in the money, and so they're getting their return, but they're not on the ground day-to-day. So now you've got two different people from two different spots and perspectives, if you will, that are participating in this deal because they both have different strengths, wants, needs, outcomes they're looking for. And that's the good part. And that's part of this is, we'll start off with kind of the traditional stuff and go into a little bit more of that creative things. But that's it. Once you get past that, traditional stuff is you can start looking for others that you can work with, that can work with you, other people that have similar or complementary goals or, things that you're trying to do in there and put some of these together.
So yeah, let's talk about traditional. Okay, guys, this is going to be a great way if you're kind of just starting out. You're getting your first couple because you have conforming loans that are good products that can help you buy properties at the early stages of your investment career before you get crazy out of whack.
Well,
depending,
I was gonna say that's assuming you have some money to put down.
That's assuming you have money to put down, right? So, like it's one of those things where if you're looking into this, like, hey, how do I tackle my first one? How much money do you need minimum? Can you attack some of these properties? There are conforming products that you could be at the 10 to 20% range and buy an investment property. Take an investment rate and buy a house, and then you're solely yours. And usually it's the purpose of buy and hold, right? Like you could do a fix and flip with that, but you might want to look at other strategies like hard money assets and other things that we can talk about for that piece of it.
Right.
But if you think about traditional financing, how many conventional loan products can you get before you start going a little crazy?
10 per person.
So yeah, so if you're married, that's 20, right? Like you could hit
each get 10 Fannie Freddie products in the traditional route, which, a lot of people then say, well, what's that? Because I've had this conversation. What's the benefit? What's the drawback? The benefit is you usually have better rates and better terms because these are your traditional conforming loans, but they do limit it to 10 per person that you can get that way.
And you're going to have to put a lot of capital up. Like it's just going to happen, right? So for sometimes to get out of mortgage insurance or some of the other premiums, like you're looking at 20-25% down minimum to get out of those boxes.
Yeah, and if you're doing if we're talking about the buy and hold, like you said, because the traditional one doesn't make as much sense for a flip. And if you're doing that, you want to do that. You want to put money down,
have a little more capital into it.
Yeah, because you don't want your LTVs to be super high. No. Whereas all of a sudden, the market takes a downturn and you're underwater on the property, or you're super close on cash flow and now it's negative cash flow and you can't carry that. So you want to have some leeway there. You don't want to necessarily push it to the limits. You want to have some room there. And so 20 or 25% in that traditional route to make sure you're not leveraged too high is probably something that you're looking at there.
Okay, so that being said, so that's pretty straightforward, right?
That's the ones everybody knows about, right?
The only other piece of that would be is if you currently have a primary residence, you haven't tapped into the investment wheel at all, and you were already planning on potentially moving. We've discussed it on the show before. Maybe buy your next primary and turn your current house into an investment property if you wanted an upgrade anyways.
Right.
That's an option.
Yeah, if you're looking to do that, it's a fantastic idea, especially
for your first one is huge.
Yeah, especially if you've got, one of those millions of people out there right now that have those super low rates on your current property. Why would you give that up? And so, yeah, if you're looking to get into this, keep that one as the rental and move on to the next one. There's been countless number of people that have started that way. Hey, I started in my starter house. That is now becoming my rental, and I'm moving on and getting the buying the house for my next primary. Now you have that rental. You backed into it, if you will. So yeah, that's a great way to do it if you've already got that first house.
So then that being said, let's go to that next, really common strategy, right? And that's hard money. Yep. We see it out there. You've heard the term hard money. It doesn't mean like a credit card. It doesn't mean like actual, like the money's hard. Like it doesn't mean you're using gold or anything. It literally means that you're getting quick assets from a private investor that's going to be swinging this thing a little bit more aggressively. Like you don't have these longer term payments.
Yeah.
You're not sitting on a 30-year fixed rate. This is going to be highly volatile. It's going to be short payments, usually ballooned out. And it's like, hey, you need to have this thing paid off in 6 months, a year. Like there's thresholds on it.
Yep. Yeah, usually, and so and we'll actually we'll go into private money compared to hard money.
Yeah.
And what's the difference there in a second. But yeah, just like Keith said, on the hard money, you guys have all heard the terms. And so typically on this, they're lending on the asset. So they're looking at
They could care less about you as an individual.
exactly. What is they're going to look at things like what's this property worth? Okay, what percentage are we willing to lend up to on that? They're going to take first lien position. Maybe they're willing to give you up to 80%, maybe 85, 90% at most. But they're going to want to typically see some skin in the game, some money that you're putting down there. But you're not qualifying for a loan because they're not pulling your credit. You're not proving income. They're doing it based on the asset that's there. And because all of that is happening, the rates are typically a lot higher. So if we're looking at high 6s or low 7s for your typical 30-year mortgage, you're going to get these hard money lenders right now. And I don't know, I haven't looked at one super recently because we haven't been doing it in this environment, but I would imagine we're up around, 9, 10, 11%, somewhere up in there.
That 10% plus right now is in that marketplace.
And
to
often
give you
with
perspective,
points.
To give you perspective, an investment type loan conventionally could be in the 8s, right? Like the upper 8s. And you're looking at that as like, okay, that makes sense because a primary rate's going to be in the low 7s potentially right now, upper 6s, depending on a lot of factors. So you're getting a couple points on the investment side, and then hard money's usually a couple points above that.
Right. Yeah, and like we said, and you're typically going to pay at least 1 point.
But big difference, it's an interest-only loan 99% of the time. Like I don't know how all hard money works, but most of the time they're like, hey, okay, we're not going to let you pay down any of the principal. It's just the interest-only payment. So it kind of offsets you a little bit, like it helps out a little bit.
Yeah, it's for short-term purposes. These are the ones you see most commonly used for flips because you're gonna pay a little bit more, but like he said, you'll typically, the way I've seen them done is either you're just paying the interest each month while you have it, which will just be a term that could be 6 months, 12 months, maybe up to 18 months on the longer end. But these are short-term instruments.
You want to get in and out. They're expensive.
Right, you want to get in and out. And so that's why you're doing it, is because there's going to be a larger profit, shorter period of time. They also have some, where you can set it up where you're not making any payments, during that time. If it's like a 6-month one, they might just tack it on to the end, or however that works. Every hard money lender is a little bit different with different criteria. They're also going to maybe have areas or properties that they're not going to lend on. Maybe some of them will say, I'm not lending on condos or whatever the case might be. And so that's your typical hard money. And then I want to talk about how it relates to private money, which is a little bit different. So hard money, think about like you're going to, we have a lot of companies here in the Valley, in our area especially, that are doing hard money lenders and have their criteria and things that are set up, and they have people working there. Private money is just often the difference is you're going to an individual. It might be an investor friend you have. It could be a family member. It could be whatever. It's just a private person. It could be somebody coming to me and saying, hey, I have this deal. Will you fund this deal? And so in that case, I become the private money. Say, yes, let's draw something up. I'm going to lend you the money for it. Here's the terms I want. That's private money. So hard money, just think about it a little more structured. Typically,
a little more
companies.
Corporate. Yeah,
a little more, they've got their criteria, whatever. Private money, you're typically just talking about one person or a small group of people, could be anybody, and it's just a private loan.
Yeah, so if you have that rich guy friend, you might want to get him in the payroll, get that thing rolling, because that's a great relationship.
Yeah, you've got people who are busy and they're doing other stuff. Maybe they're running businesses or they're, high-paid doctors or whatever.
Their money sits in the bank account.
And their money's sitting there. So they're very interested in that. If they've got somebody they can trust and they can put these in there and get a return, absolutely. That's where you see a lot of this private money coming from.
Well, let's go into DSCR here. A very interesting term. Do you know what the DSCR stands for?
Yes. So we've got DSCR loans, debt service coverage ratios.
Yes.
Keith, what the heck does that mean, dude?
It's basing a lot of it off of your assets, and they're not using it. It's kind of similar. It's an investment-only product. You're not going to do it as a primary house. It's a more traditional way of getting financing away. So, like if you put hard money on one side of the scale and then you do traditional on the other, DSCR finds itself somewhere in the middle there.
That's a good way to put it.
It's not as aggressive as a hard money. You could carry a DSCR loan for much longer. You could keep it long term. It just depends. Maybe they're 20 years, 30 years. You can map them out, but it's an investment product that isn't going to rely solely on your debt to income ratios and some of these things, it's going to rely more on the property itself as well.
Right. They're relying on, like the product says, the debt service coverage ratio. And so what they're looking at is what will the payment be? So let's say in the case of a long-term rental, excuse me, let's use an example that says, hey, your total mortgage payment is going to be $2,000. Okay, so that's your debt service. Okay, so that's the first part of it. And then they're going to say, we project the rent will be $2,500. Okay, so that's the coverage ratio part. So they're taking the $2,500 over the $2,000 and saying, okay, your debt coverage ratio is going to be, whatever that
High
is,
enough.
1.25 or whatever.
And then do you have enough assets to cover the rest?
Correct.
Yeah.
So then it's saying, okay, that covers it. You meet our criteria for the debt service coverage ratio that's on this. And so based on that, based on the expected rents that you're getting and what your debt service is, we're going to give you the loan based on that, knowing that this is an income property. And so like Keith was saying, this is just for investment products. So this is another option if you're looking to buy those long-term rentals and you go, hey, I don't make enough income to qualify for the next one. My debt ratios are off here. You can look at this, which is kind of
it's a product-based loan.
Correct. And it's a little bit more hybrid, a little more towards the commercial side where you go, okay, we're going to look at the debt and the income based on the fact that it's an income property to qualify you for that loan.
Rates on this are going to be higher as well. They're a little bit more strategic, and it gets into the little bit more of the wild, wild west. So lenders charge points and fees on these products, and it's not regulated like a lot of the other things are. So you have to be a little cautious as you're picking the right investor. Some investors are going to be like, hey, we'll do a DSCR product, but we're going to charge you for it. And you're going to pay up front with points, or you're going to have a higher rate. Like they take that risk. There's something that you could carry long term, and you wouldn't want this product for a short term flip. Like it's just not.
Right.
It'd be better to get in the hard money. There's way less overhead and risk in certain things, and a lot more of hoops to jump through. Hard money is easy to take down and sell. So good product, but still a great option for those of you guys looking for long term holds that might be at the end of the rope when it comes to your assets and what you can be able to leverage if you have capital still to invest.
Yeah. Let's talk about one. This is going to be more in the flip category. So this is maybe you're building something brand new, or you've got a flip and you've got to piece some stuff together. And that's a term that some people might have heard called bridge loans. And so bridge loan, kind of, if you think about it, if you picture it, it's a bridge getting you from one side to the other. So you could use it in a couple of different ways in a couple of different scenarios where, like I said, maybe you've picked up a property through traditional financing, or you put a DSCR on it, or you got hard money on it, whatever it is. And now you need another loan, a bridge loan, to maybe fund that rehab. You bought the piece of land and you're going to use a bridge loan to build it. That's going to bridge you to the other side, some permanent financing. And so maybe if you bought the traditional, you're going to use bridge loan, let's say, to rehab the place. Maybe it needs major rehabs and it was just completely, dilapidated before. You're going to get that temporary financing, that bridge loan, to get you to the other side, and then you're going to refinance, on the other side of that. Same thing if you've got, hard money there, and now you've got to get a bridge loan for second part of that, and, you're going to get to the other side and sell it or refi it or whatever you're going to do. Again, similar thing if you're buying land and you're going to build on something, you've got that bridge loan. So the bridge loan is like that in between, like just like the name implies, you're bridging it to the other side. And so you're typically going to tack that on to something else that you're doing to help you get to what the ultimate goal is over there.
You can see this a lot in primary properties as well. People use this product when they're building a house or doing a custom build or some of these other products, like you're saying. It doesn't always have to be a fix and a flip, but it could bridge the gap if you want to fix and flip it and then buy and hold. It's another really strong play that you see it happen. So maybe your goal isn't to sell it, because if your goal is to sell it, maybe hard money is still the best route, right? Like in certain situations, and you don't need a bridge. But if you're trying to keep it down and take it down as a long-term hold, this is a good option for a lot of those pieces.
Yeah, and then let's get into one of my personal favorites, okay, and something that I have used more than once before.
Credit card debt.
Credit card, no.
Yeah, 28% variable rates.
Sounds like a fantastic idea.
Credit line advance. Maybe something.
So
gambling. Which one is it, Pete? Come on, help me out here.
Casino money. So seller carry, seller carry back.
Of course.
So you guys have heard that. And to me, I love it because, you know, you usually.
You're currently carrying something, aren't you, right now?
Well, I've had, so the current house I'm in, I originally got through a seller carry. We
Which
don't
is
have
great.
anymore,
That was
right?
fantastic.
Yeah, so that was for a personal residence, right? And so, like I've said, I love this one. It could be great, and it's a win-win for both sides. So, you know, using some of my just personal experience with those, you've got somebody who doesn't necessarily, let's say you own that property, and 9 times out of 10, when we're dealing with somebody doing this, they own it outright. And so
Yeah.
they may not want to sell it and pay the capital gains. Maybe they don't want to 1031 it into something else. Maybe they don't want to deal with that anymore, and they just want cash flow. And so now it actually becomes a burden to get all this cash, which is weird to say, but people have to think about that. If you're at a point
Where are
in
you
your
gonna
life
put
where
it?
you don't need it, you've got to put it somewhere. And the bank is not usually a great place to
Good
put
problems
it.
to have.
Good problems to have.
I got all this money. I don't know where to put it. Well, the IRS has a solution for you.
Exactly. You don't want to give it to the IRS. So anyways, there could be any number of reasons, but seller carry or seller carryback just works. It's I want you to think about the whole rest of the transaction is exactly the same. So you can use it for primary residence, long-term buy and holds, for flip properties. You can use it anywhere because all you're doing is instead of going to a lender, a mortgage bank or a traditional bank to get a mortgage, the seller becomes the lender.
Yeah.
That's it. And so the rest of the transaction is exactly the same, except, you know, you're not going to Bank of America for that mortgage. You're going to Bob Smith, who owns the house. And he goes, I own it free and clear. We'll agree to a price, you know, same terms. You'll typically do a amortization over a 30-year, but the term of the loan will typically be a lot less. Could be 3 years, 5 years,
Yeah.
10 years. But for your payment, they say, okay, we'll amortize it for 30 years. That means your payment is X, but the loan comes due in, 5 or 10 years.
Yeah, I mean, if you think about it this way, guys, like in this marketplace where rates are climbing and are higher, I mean, as a seller carry, you could get an 8% loan pretty easily. Like an 8% return on your investment, if you had that and you were going to sell the property anyways and you want some cash flow, and if they never hit payment, you could always foreclose and take your property back. Like there's a lot of
You're
cool
in
play
first
there.
lane.
So like, think about it, guys. Like, how often do you get a good 8 to 10% return on your investment, and it's pretty much guaranteed? And if it doesn't happen, you get your full asset back. Like,
Right.
there's a lot of wins there for the seller.
Not only that, but typically you see sellers who can use this to get a higher price.
Yeah.
Because if a person doesn't have to qualify for a loan, doesn't have to show up on their credit, they don't have to do anything. Well, as long as you can afford the payment, you might be willing to go. He might say, okay, well, if I went on the open market, it's a tougher market right now. Maybe I could get, $550 for my house. But if I say, listen, price is $550, but I'm willing to do a seller carry, I know even for me on the buy side, yeah, I'll pay top of the market if I don't have to do anything there. And, I could put a small down payment, or sometimes in rare instances, no down payment, and just get into the property where I can afford the payment and make it happen. There's wins on both sides there. This is where you start getting those creative things and go, what's that person looking for? What are you looking for? These seller carries can be a lot of win-wins. You can even see them advertised on the MLS where people will say, hey, seller willing to carry back, and they might put some things in there with, certain down payments or something like that. But there's a lot of options there.
Yeah.
So that is definitely one, avoid the banking system altogether, the banking system altogether, and just go there.
Yeah, so I mean that hits most of them, but there is one on this list here for us that we've talked about, that we've seen it, and it's kind of that weird curveball that everybody's like, what do you mean?
Yeah.
What is this? So Pete, tell me about subject to.
Yeah, and I know we haven't personally done any of these, but we've got some folks on the team and Pace Morby here locally that we've talked to and done some things with there that really specialize in this stuff, guys. So but it's another option if you're looking at how else can we get creative on it. Excuse me, and that's the subject to. And so that is where somebody, you might look at these. And we just looked at one recently where maybe the seller's underwater. They just bought just a little while ago and circumstances have changed. They've got to get out of there, but they're underwater. So you can't do some of these other options. They don't have any money to bring to the table. It doesn't make sense to go there. And so you might sell the property subject to. When we say subject to what? Well, it's typically subject to the current mortgage. And so they might have a low rate or a decent payment on there that you want to take advantage of. And so it again can create a win-win by helping that person get out of that property that they need to. They're moving or they're struggling in there, whatever the case is, put somebody else in place that's going to do something different. It could be a primary residence, short-term rentals, long-term rentals, whatever it is. But again, if they're just looking at, okay, here's the payment, that seller's keeping it, we end up using, without going into too much detail on it, you set it up through a third party, where you are making payments through that third-party processor into the current mortgage over there. And so you're doing it subject to that current financing, low rate, good payment, whatever it is. And now you can either live in there, rent it out, use it as an Airbnb, and make it happen. And now it gets that person out of that property. Again, it's a creative way to get a win-win. Again, we don't want to get too far into this, but yes, that loan stays in their name. Yes, after a period of time, they can get documentation to show that somebody else is covering that, and then they can, move on to buy other properties. There's a lot of nuances that go into that, and it's longer than what we've got here today. But just know that's another one. And with any of these, we're touching them on the surface, and you can always go deeper. You can reach out to us or someone else that who goes, hey, I'm really interested in this, and let's talk a little bit more about that before you just go out and try something on your own, right?
100%. Well, guys, I appreciate everybody jumping on and hearing the conversation. At the end of the day, if you're looking at investments, don't just always look at the traditional route. Make sure you look at all your options, look at all your pieces to your puzzle, and make sure you have the right fit for the right box, because there could be way better assets that you could leverage in one degree than in another degree. Yeah. And so that's our encouragement, guys, is that also if you're worried about a flip because you don't have 25% to put down, that doesn't mean you can't buy something. It doesn't mean you can't take something on. So start thinking outside the box. This is the whole point of this. And start getting into your first investments and start moving down the road to where you want to be.
Yeah, absolutely. There's probably even more. Like I said, we touch on most of the main ones. I mean, we even talk about collateralizing other assets or other things. There's a lot of ways. Don't let this. Keith likes gambling.
Peak tickets for houses. You could gamble it if you really want to.
You could do that, but don't let this part stand in your way. If you've got a good deal, you can find other people that can work with you. You can find other avenues. Reach out to people that Reach out to us. If you've got something you're trying to figure out, we could help figure that stuff out as well.
All right, guys. We will see you guys next time. And again, follow us at the KP Lee, and we will see you guys in a couple weeks.
See you guys.